The stock market could be very intimidating. Many people have lost a lot of money, many people have made a lot of money. And if you're thinking about investing, if you're a beginner, don't do anything until you watch this video. In this video, I'm going to be teaching you 4 newbie investor mistakes that beginners make. All of these mistakes I've personally made myself, and hopefully this video will serve you well. Mistake number 1 is going to be short-term thinking. Many people see all these so-called gurus that are making millions of dollars trading stocks, and they think that this is the way to build wealth and this is how you should do it. The fact is that only a very, very small percentage of people can actually be profitable, let alone make a lot of money trading stocks. I can go on for hours about why trading stocks is a bad idea. Just a few reasons. You have to stay glued to your screen. It's an emotional roller coaster. It takes a ton of practice. You have to look at charts, be able to read fundamentals and all these different indicators. It's a disaster. There is also definitely luck involved, and very, very few people actually end up coming out on top. Even Warren Buffett himself has said that he cannot beat the S&P 500. Just because a select few out there maybe got lucky doesn't mean that you'll be able to do the same. True wealth has always been created through the long-term and compound interest way. This is the kind of money that's generated while sleeping, while eating, does not matter. Your portfolio is generating you cash. The investors on the Forbes list today, you ask them, you take a look at their portfolio, it's always been through long-term assets, whether it be stocks, real estate, investing in businesses, does not matter. They went for the long-term play. They had the long-term mindset. Thinking long-term is also beneficial not only for yourself, but for future generations and what you'll leave behind. Second mistake I always see is people that shoot themselves in the foot and they panic too soon. Investing in the stock market does take mental strength, and you have to be ready and prepared to see your portfolio in the red 20, 30, 40% during a crash. So far, we've had an insane bull run of over a decade since the 2008 crash, but no one truly knows how long this could last. A crash can happen next year or in 5 years from now. No one knows, but it can happen.
Nobody. I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if a stock is going to go up, down, sideways, or in circles.
So you have to be ready for this, and when you see that you are down, you cannot sell. In fact, you have to have the mindset of this is a good thing, because now you could scoop up more at a discounted price. If you genuinely feel that you cannot handle this, that's perfectly fine and understandable. You could feel free to use a paper trading account where you could just use fake money to invest. This will give you a good glimpse into the investing world, and you won't have to worry about any risk because you're not using your money, it's fake money. But even when there is a bear market and your portfolio and the market is crashing down, you should not worry if your portfolio is diversified and has stocks that pay good dividends. It's debatable, but I feel genuinely that if you do not have all your eggs in one basket, you are much better off. Diversify your portfolio and allocate some in bonds, some in REITs, some in individual stocks, some in index funds. This way you won't have to worry too much. Diversification will give you an edge, and you potentially might even be able to come on top of the market. When your stocks are down, your bonds will most likely still be going up. Even if your prices are down, you'll still have those great dividends. They may not be as high as they were before the crash, but it will be something to hold you over. A crash is actually a great time to buy stocks at a really discounted price, and you'll also average out the cost that you paid for your stocks, so you won't be too much in the red. If you look at some blue chip stocks and what you could have picked them up for in 2008, and then you look at what you would have made over the last 10 years, and the return on investment that you would have made, it would have been really crazy. It's also important to know that if your portfolio is in the red, it's not until that you click that sell button that you've actually locked in that loss and realized that loss. So just because that your portfolio is down that much doesn't mean that you've actually locked it in. Number 3, this is more so of a misconception than a mistake, but I think it could still be considered one. People don't invest because they think that they don't have enough money to do so. People think that you have to have tens of thousands, hundreds of thousands, millions, billions of dollars to invest in the stock market or to make any money, and that is totally not the case. In fact, you probably spend every single day money that could be used to build your wealth. Let's just forget about any miscellaneous things or impulsive buys that you might make, and let's just look at a simple $5 cup of coffee every single day. So let's just say here you spend $5 a day at Starbucks, and again, that's a nice, generous number. You're probably going to spend more than that. Most people spend a lot more than that with food, whatever it might be, but let's just say $5, and let's just say that you don't go the whole 365 days. Let's just be generous and say you only went 300 days out of the year. So times 300, that is going to give us 1,500. So that's 1,500 a year that you're spending at Starbucks, not even thinking about any other miscellaneous things you might buy. And this is just a coffee run at Starbucks a day, not even every day, but $1,500. Let's go to the compound interest calculator here. Let's just say current principal would be 1,500, and every year you would spend that 1,500. And years to grow, let's say 20 years. You're probably going to need coffee for more than 20 years. And let's just be nice with an 8% annual interest rate. Again, to me, that's a little bit generous considering S&P 500 can do 10% just about, but 8%, let's just be nice and calculate that. That would be $81,125.82 that money could possibly be worth. But if you went to the calculator here and you did 1,500 times 20 years, that would be $30,000. That's just about $50,000 profit that you'd actually be making instead of losing $30,000 for that coffee that you'd be spending your money on. So it just goes to show you the power of what just a little bit of money every day you could do. You do not need that much money to invest. And the fourth mistake, people get largely distracted. They read something online, they hear something from a friend, they give into the hype, and they end up losing money. You should never invest in something just because someone else said to invest in it. You have to do your own research on what you're buying, and don't just listen to someone else because they said now is the great time to buy. Only invest in things that you understand. The stock market is a great place to make some great money, but it can be very scary as well, so make sure that you do your due diligence. With that, I hope you enjoyed the video. I hope you got something out of it. If you did, be sure to smash that like button. It helps more people see more videos just like this, increases that algorithm. And if you haven't already, be sure to subscribe to the channel. I post videos every single week, and hit that little notification bell so that you're notified every time I get a new one. See you in the next video.